certainly, if these aren't Trump numbers on the economy, these are Trump numbers on the markets. What do you think about the hit the equity indexes have taken?
Well, what we have seen so far is that U.S. exceptionalism is coming under pressure, and specifically U.S. growth exceptionalism is coming under pressure, and U.S. tech exceptionalism is coming under pressure. But let's be very clear, the current growth data does not point to us heading towards a recession. You look at the robust job creation, you look at the still very good kind of earnings expectation for this year, 12% expected for this year, revised down from 14% at the beginning of the year, but still consistent with slightly even above trend trajectory, right? So the current data in terms of growth does not point to recession. But of course, if this extremely elevated uncertainty were to persist, there is a path towards there. But we do think that the sharper the economic pain, the sharper the market pain is going to force a quicker kind of journey towards policy clarity, and that itself may well lead to some of this policy uncertainty, risk premium being priced out. So that's on the growth exceptionalism. Currently, the U.S. economy is not doing so bad.
Right.
And then in terms of tech exceptionalism, markets obviously have sold off, but in our assessment, it is not commensurate with worsening fundamentals. You look at CapEx indication, it's even up 40% versus what was a record year last year, despite DeepSeek and profits and margin and earnings expectations. They haven't notably dropped either. So there is a bit of a disconnect. And I think the very elevated policy uncertainty is the reason, together with deleveraging and some of the crowded positions being washed out.
So let's put this together and how investors should be thinking about their portfolios right now. You mentioned this policy uncertainty actually could force clarity when it comes to maybe some monetary policy, but you also mentioned maybe the fading exceptionalism of American equities and American tech. And if I put that together, what does that mean for how I should be weighting the U.S., for example, versus Europe versus maybe Asia?
Well, we recently closed European equity underweight because we see this market being so unloved, so underowned. Now there are momentum catalysts for that to turn around that can go on. So we're neutral European equities. We're keeping our Chinese equity tactical overweight as well. A similar story applies there. But we're not downgrading U.S. equities at this juncture because the price action, like almost 10% from peak to trough at this point, is overpricing recession risk in our assessment. So we're also keeping our U.S. equity overweight. You look at tech specifically, last year we went overweight tech since mid-2023. And for most part of that journey, I hear investors and clients come to me and say, well, I don't question the tech story. I don't question the AI transformation, but it's just price is too much. It's gone up too high. Now, fundamentals haven't deteriorated and price is quite a bit lower. And all of a sudden, people are getting very anxious about it, right? So I think for those that do have the luxury of not having to de-risk at this juncture, there are good opportunities right now. But I would say, though, markets pricing in terms of treasury and market pricing as though it can be a good recession diversifier or portfolio diversifier that is under appreciating the sort of environment of high debt and inflationary pressure that we're in. So we would lean against treasuries acting as a recession diversifier in this environment.
So, Sonali, a lot to dig into there, but the tactical overweight in China kind of reminds me of what we were talking about with Carson Block yesterday, that China is a trade. Don't get married to China, but you can date China.
Yeah, no, it's very interesting because, of course, China has its own uncertainties on a macro basis. As far as the macro basis in the U.S., you also said that you are not underweight the United States, but you look at strategist after strategist lowering their price targets. You look at an S&P 500 that is not only down on the year, but has struggling for now many weeks to break back sustainably above 6,000. So my question is how much more downside risk there is before things get better?
That's a great question. Let me clarify a little bit. I think in the near term, the crowding position getting washed out, and there are still some of that in the system despite the significant deleveraging that we have seen. So that dynamics can still put pressure on U.S. equities, and certainly we're seeing extraordinarily elevated level of policy uncertainty, and that should warrant a higher risk premium at this current juncture. But over the 6 to 12 month horizon, which is our tactical asset allocation horizon, we do believe that some policy clarity will be forced out of market pain, and that should lead to some of that risk premium getting priced out. And ultimately, we're in an age of populism, and what happens in Wall Street and Main Street should matter. One cannot tolerate pain for too long. So it is a matter of time horizon, I would say, and the fact that current market disconnects with worsening fundamental, which is not a huge amount, is why we're not downgrading our U.S. conviction at this point, but very much recognizing that there are very good reasons that markets could come under pressure in the very near term.
All right, that's a good place to leave it. Really great to get some time with you. That is Wei Li of BlackRock.